There are signs that the modest coronavirus-induced housing correction has come to an end. Now, nobody's going to ring a bell telling us the market's bottomed, but I'm sure when we look back in 12 months' time, we're going to find the value of some properties have increased significantly. And as usual, other segments of our property market will continue to languish. Now, I'm not denying we're still going to have some challenging times ahead. We are. But the recovery of our home values has been underwritten by a number of factors that we're going to discuss in today's podcast as I have a chat with Stuart Wemyss. Stuart's going to explain which type of properties are going to lead the recovery in 2021 and why buying the right property next time round is going to be more important than ever. And in my mindset message, I'm going to share with you one of the most important lessons I learned from one of my mentors, Jim Rowan, as we're going to talk about the miracle of personal development. Welcome to today's episode of the Michael Yardney podcast. At the end of today, I hope you're going to have a bit more clarity on what's going to happen in our property markets in 2021 and what you should be doing to position yourself correctly.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
One definition of an economist is somebody who can explain to you tomorrow why what they predicted yesterday didn't come true today. Well, that's a very apt description of the behaviour of many of the economists we're seeing daily today in the major media. Boy, have they done a backflip on their predictions earlier this year of 10, 15, 20, even 30% drops in the property market, in the residential real estate market. Now, we know some segments of the property market are suffering and will continue to, but there's lots of green shoots ahead as well. Now, one of the people who has forecast things over the last couple of years and got it right most of the time, is my regular guest, Stuart Wemyss, Director of Pro Solutions, who writes a regular blog, writes for The Australian, has got his own great podcast, written a number of books, and we'll get into some of those things as well. Welcome, Stuart.
Hey, Michael, great to be with you again.
Well, you're one of the people who suggested that we weren't going to have real estate Armageddon earlier this year. Why were you so confident?
Because I knew I didn't know. I suspected that the government would have to really wear most of the cost of the shutdown as a result of COVID. Now, that's impossible to do to 100%. But I knew that because COVID has been really no one's fault, well, except for maybe what Mr. Trump might be suggesting otherwise, but through no fault of anyone, businesses have had to shut down. We've had curfews. We've had all these sorts of lockdowns and restrictions that have had an impact, but it's been no one's fault really. And so the government really had to wear most of the cost of that. And we've seen it globally, not only in Australia, but globally, that the amount of stimulus and quantitative easing and all these sort of financial injections into the marketplace are completely unprecedented. The cost of significant unemployment, the cost of a share market crash, the cost of a property market crash, these sorts of things as a result of a pandemic are far more costly than actually getting in early and trying to stimulate and at least dampen the damage. And so that was my viewpoint. The other thing too, Michael, as I sort of said, it's easy to go and sell shares. Like if you think, oh my God, the world's going to end tomorrow, I'm going to dump all my stocks. You can, a couple of clicks and it's gone within a minute. But to sell property, it's a much longer process. And then if the property you're selling is your home, it creates a practical consequence as well. You know, you need to go and find somewhere to live. So the decision around exiting property is a more difficult one, and it has a longer timeline. So at least that then allowed the government to react and everything sort of calmed down a little bit and normalize. Whereas with the stock market, that's a bit different. We can be a bit emotional and very reactive in that marketplace.
I think the government also recognises that the importance of consumer confidence in getting our economy going again. And they realise that if people feel comfortable about the value of their home, their castle, they're more likely to go out and spend. But if they see the value of their home going down, they're more likely to stash their cash. So they've brought out a number of incentives, and maybe we can talk about that a little bit later on to get the property market going again. But recently you wrote in your regular column in The Australian that you see the top end of Australia's property market is going to lead the housing recovery. Why do you think that's the case?
Yeah, there's a few reasons for that decision, Michael, but mostly if we have a think about who's being impacted as a result of COVID, mostly it's lower income earners and also younger people, which could be tick both those boxes. Whereas higher income earners typically have been impacted to a lesser extent, unless they're working in some of those really highly impacted industries such as hospitality and travel and tourism and so forth. And the reason for that is that, higher income earning occupations tend to lend themselves more to work from home. Whereas, if you're a builder or a cleaner, or those sorts of occupations, you obviously can't do those sorts of things from home. And so they've been impacted to a greater extent. So I know certainly from my client base, I can count on my hand the number of clients that are on JobKeeper, the number of clients that have really had any sort of financial impact. And a far greater cohort of clients I have are actually in a much stronger financial position today. Even some surgeons and doctors and so forth that, because of the restrictions on elective surgery over this year, their income has been impacted to some extent, but they're bounced straight back, and their financial position hasn't been impaired. When we think about COVID, and we certainly watch the news, and it's terrible, and some economic and health consequences are completely dire. I feel so sorry for people that have an otherwise fantastic hospitality business, for example, and if they're in Melbourne, they haven't been open for 6 to 9 months. How long? So it's a terrible situation. But we must remind ourselves that there is a cohort out there that are in equal or stronger financial position as compared to pre-COVID. And that cohort has a lot of borrowing capacity, and that cohort has a lot of spending capacity as well. And it's from a macroeconomic perspective, that cohort probably has enough financial power to offset most of the impact, or maybe sometimes all of the impact of the people that have been impacted. And we see that in credit card spending data. So the banks release every week what their customers are spending on by state, by category, etc. And of course, Melbourne's total spending is less than what it was a year ago, and obviously because we're in stage 4 lockdowns, although it's rising. It's come off its lower levels from about a month ago. But all other states are spending either equally. In New South Wales is about even to last year, but the other states, excluding Victoria and New South Wales, are spending 5 or 6% more than what they were last year. So that's I think, strong evidence that there is a large cohort of people that have been impacted.
Yes, there has. And we're noticing the same, which really means there is a greater divide between the haves and the have-nots. And we're not trying to bring this into a social argument, because that's going to create its own issues. But one of the things it's likely to create also, Stuart, in my mind, is a two-speed property market, because some segments are going to pick up well, I agree with you, and others are going to suffer. Currently, the properties that are selling, if you dig deeper into the statistics, tend to be the lower end properties. People in the middle ring and more affluent upper ring, inner ring suburbs, they're not selling. They've got a lot of equity in their homes. They're not upgrading. They're not downgrading. They're not being discretionary buyers or sellers. They don't have to move. But the fact that a lot of lower priced properties are selling and apartments are, that's one of the things that is probably going to pull down the median prices, because that's part of the way median prices work, to give a more negative reflection of what's actually happening out in the real world than what happens if you're sitting on the ground and seeing what's going on.
I totally agree in terms of a two-speed market. if I'm worried about the property market and property prices falling, I'm not worried from a macro level, and I don't think we'll see any reflection of falls really in median data. But if I think about a couple of sectors, there would be two sectors that I'd be concerned about. Regions that are dominated by lower income earners, the sort of lower socioeconomic peoples, that could be a concern. I'm not saying that will be, but it could be, or at least they're more vulnerable to price depreciation. And then certainly, maybe inner city apartment market, so high rise, student accommodation, short-term let, short-term stay, that sort of style of property that that neither you or I would have ever advocated anyone to buy, let alone at least invest in. That's probably vulnerable as well to those sorts of depreciation. But if you then compare that to locations that are, blue chip, inner city, suburbs, the good quality ones, you're comparing apples with oranges. They're completely in two different situations that are benefiting from two different bits of demand. And one thing I actually haven't written about yet is the loan pauses, because, when we look at loan pause data and the hundreds of thousands of people loan pause, you look at that and go, oh, well, people must be suffering. But I saw some stats recently that said 9 out of 10 of the greatest loan pause suburbs have been in southeast Queensland. And you go, okay, well, maybe it's tourism, because they've obviously locked their borders, so that could be impacted by tourism. But I actually think and I don't necessarily yet have found any data. I haven't been looking, but my gut feeling here is that most people have paused loans through convenience rather than necessity. And I think it's a very poor financial decision to do so. But I think some people have seen it as like a bit of a free kick. Like, oh, well, I don't have to make my repayments. They haven't thought further ahead beyond the 6-month period and what happens and interest and all those sorts of things. But I think some people have gone, well, loan pause is great. I'll stop repaying my loan. I can spend a little bit more, at the pub or, shopping or whatever I might want to do. And then when loan pauses come off, that's okay. People will just go back to repaying their loan. So I don't necessarily think it's a reflection of financial hardship. I think it's probably a reflection of poor education, and perhaps the government and the banks should have done a little bit more to educate people in respect to that.
Makes sense. Now, some people are probably thinking, well, if the lower end of the market has dropped a bit, maybe I should get in and buy a bargain while I can at the moment. The problem is in those areas, the tenants are also having trouble. So there's two types of tenants. There's the lifestyle tenant who rent in the sort of areas that we were just talking about, the better class areas, the investment grade areas, the more affluent suburbs. So some people rent for lifestyle and others rent because they can't afford to buy. And in general, they're also the ones who are suffering a little bit more with the effects of the COVID cocoon, where businesses have closed down, where employment is up, where jobs are not at their full tilt as they were before. So buying a bargain, a one-off bargain, isn't going to help you if you're not going to get the capital growth in the medium to long term. And if your tenants are going to be the ones living from week to week, a couple of $100 away from broke, that could compound the issues, Stuart.
Yeah, and I think rental increases. I mean, it's funny, I was speaking to a property manager in Perth recently, and he was saying that rental increases have gone through the roof in Perth, which is pretty interesting. Or that market has they haven't really been impacted by COVID, have they? And that market has had its own challenges over the last few years. But you're right, Michael. I mean, there would be nothing attractive to me about going and buying a property in a distressed area. To my mind, I think you're probably just buying a whole bunch of problems. The vacancy rates and the tenants and the income that you might generate off that property is going to be questionable. Whether that market is really going to turn around and how long it will take to turn around is also questionable. And I think when you make a decision like that, what you're doing is making a very short-sighted, short-term decision. And for that to work out, you need to perfectly time your entry and exit, net of all costs like stamp duty and selling costs and so forth. And even if you can get that timing perfect, so you know when to buy and when to sell, I think the costs probably eat up most of the profit in any case. So I can't see a lot of upside from doing something like that. And the quality of, we've always said, the quality of the asset that you invest in will dictate the the long-term outcomes. You can't get high-quality returns from a poor quality asset.
Now, interest rates are an important part of the investment equation. We've often both said that property investment's a game of finance with some houses thrown in the middle. And about a month or so ago, Josh Frydenberg announced that next year he's planning to loosen lending criteria. To me, Stuart, that's a major game changer that's going to underpin our property markets.
It's huge, and my estimations, it depends on client circumstances, banks, loan structure. There's a lot goes into it. But my estimations, maybe some people's borrowing capacity will rise by 20 or 30%, which is substantial and could mean, people that can't afford to buy or add another property towards their portfolio might be able to do so now. And then people that were sort of at entry level now might be able to dial up in terms of quality and spend a little bit more and get a better quality asset. So from a practical investment perspective, it makes a big difference to individuals. But from a property market perspective, we know that there is a very strong relationship between money supply and capital growth. So that is when more money is flowing into the property market, and obviously most people's, in terms of capital, most people are borrowing that, so that goes to mortgage volumes. When that is high, that stimulates price growth, and it makes a lot of sense, right? If we've got sort of an unlimited money supply, no one does, but just notionally, then we're going to probably go out and buy more, buy higher value properties, those sorts of things. So it's a massive game changer. And I think that the tightening credit has certainly had an impact on property returns over the last 4-ish years, I would say. It's had there's been a lot of other factors like COVID and the election and negative gearing, these sorts of things, but it has had a pretty substantial impact on those returns. And so with that lifting, that's certainly a fantastic outcome for people that currently hold properties, and a great opportunity, I think, for prospective investors as well.
I think it leaves a great window of opportunity to get in before the market picks up substantially in the second half of next year. The other factor involved, of course, is interest rates, and they're going to remain low for a long time. That's been announced by the Reserve Bank, and it's clear that they're not going to raise interest rates until unemployment comes down substantially. But interest rates are likely to have a larger impact at the top end of the market, the luxury end of the market, which flows in with the point we were discussing a bit earlier on the two-speed property market, Stuart.
That's right. Borrowing $1 million 10 years ago was going to cost you about 70 grand in interest alone. And that's substantial. Whereas today, if you're a home buyer, it's going to cost you $20,000 to $25,000, a third of the cost of interest. Now, of course, we had some principal repayments in there too, in terms of cash flow costs. And you do need to add in a buffer. Obviously, interest rates probably aren't rising anytime soon, but they will rise at some point. So we can't lure ourselves into a false sense of reality that they're never going to rise. But that being said, money is cheap. And if you're contemplating purchasing a $1 or $2 million property and you do need to borrow $1 million, it's substantially more affordable today than what it was 10 years ago. Now, if you're at the lower end of the market and you're contemplating buying a $300,000 property, it is also cheaper, but to a much lesser extent. Higher income earners tend to be more conservative, in terms of how much they're borrowing compared to their income and compared to their cash flow surplus. And so that will help those people get their head around borrowing more than what they might have otherwise done. And I also wrote a blog, I can't remember, a few months ago, talking about the impact of non-deductible debt. And in the past, if a client contemplated having a large amount of non-deductible debt, that would be one of the financial planning considerations at the top of the list, if not number one, in terms of what are we going to do about it? How are we going to get rid of it? How are we going to repay it? Because obviously, because you don't get a tax deduction for the interest, non-deductible debt for a higher income earner is twice as expensive as investment debt. But today, assuming interest rates are going to be low, and look, the RBA said no change for 3 years, could be 5 years. I don't think they're really going to change until we see certainly core inflation, but specifically wage inflation rise. And that could be somewhere between 5 and 10 years or even longer. So the impact of holding a larger amount of non-deductible debt today is substantially less concerning than what it was maybe 10 years ago. And so that has an impact too in terms of home buyers. And remember, home buyers tend to be emotional buyers, and that's good for the market in terms of property prices and appreciation and so forth. So having a good balance of home buyers and investors in the market, we don't want the market necessarily dominated by investors, creates a more robust market, I think. So those interest rates factor has a practical element and then a financial planning element, particularly from the respect of non-deductible debt.
Now, Stuart, a little while ago you wrote a blog saying that the next property you buy is the most important one. Is that really true? Isn't every property you buy important?
It is, and I wanted to say I contemplated calling the article "The first property you buy is the most important," but I felt like if people were reading that and they didn't nail that first property decision, they might be a little put off.
Yes,
I guess
but it is. I think you're right, though. I think the first one is because that's one of the reasons that a few property investors actually can climb up the property ladder and most don't because they get the first decision wrong. And many sell up. It's a while ago since I read the statistics from the AHRIU, who was doing a study and showed that 20% of people who buy an investment property sell up in the first 2 years. 50% sell up in the first 5 years. Now, that was about 10 years ago, and I haven't seen any subsequent studies. But in my experience dealing with people, that's the case. A lot actually get the wrong finance, buy the wrong property, realise that they've been taken advantage of by marketers. So maybe let's get back to your concept. How important is it to buy the right property, and which property is the most important one?
I think the key to the article was that good decisions compound, and we must really recognise the benefit of the making the right decision 3 decisions ago. So let's just notionally say that every good decision creates $10 worth of value. So if I make that first financial decision, which could be like the first home that I buy or the first property that I buy, and I get that right, that's $10. Now, if my next decision is good too, then you might say, well, that's another $10, it's 20, but actually it compounds. So I think if I make 2 consecutively good decisions, instead of creating $20 of value, I've created 30. And then the next subsequent decision then creates $60 worth of value. And all of a sudden you get, if you're comparing 2 people, 2 friends or 2 work colleagues or 2 family members, someone that's always making really silly financial decisions and someone's always making really prudent financial decisions, the difference in financial position over time is drastic. Initially, it's not a big deal, but it becomes drastic. So that's what I'm saying. So the next property you buy could be the platform for which you leap off to make consecutively good decisions. I remember my first property that I bought was in Moorabbin, in a suburb in Melbourne. I paid, I think, $151,000 for that property. It was a terrible property. I mean, if I bought it today, I'd probably just bulldoze. I wouldn't even look at it. But anyway, I was young. I did a bit of work. I did all the work myself on it. I sold it, I think, about 3 or 4 years later for $330,000. So I've hit those statistics that you talk about, Michael, in terms of how long you hold that first property. I knew nothing about property. In fact, I was contemplating one just around the corner, but it was on a main road. So at least I got that decision right. But that was by chance rather than design. And I used that money. I ended up selling the property because at the time I thought, I was young, let's move into the city and let's start a business. And I started Pro Solution. So that money that the capital gain that I made from, I lived in the property, so it was tax-free. That capital gain I used as a financial buffer to start a business. And I guess we can look back and go, well, that good decision compounded. And that's why I think if you've made a whole bunch of mistakes previously in terms of property or otherwise, no big deal. But your next decision that you make, if you look back, if you get it right and you look back in 20 years' time, that decision could be, or is arguably, the most important decision that you make. And so if you buy a really good quality asset, you focus on the long-term fundamentals. You play that long game. You make the decision of what property, where can I buy the property so that I'm substantially better off in 20 years, not 2 years. If you really focus on that, that's how you can sort of leapfrog your financial position.
I think one of the comments you made a bit earlier on was very pertinent, that when you have your two friends, or she buys one property and you buy a different property, and they perform much the same in the early days. So the difference really doesn't look much different, but over time it just gets wider and wider. We've seen those charts where one line keeps taking off and keeps shooting up and the other one remains flat, and the gap widens consistently, which makes me realize that maybe one should be considering what's happening with your portfolio at the moment. Is it actually going to get you to the next step? Is it going to get you to where you want to go? Because if you don't do something about it now, the gap is only going to keep widening between where you are and where you want to be, Stuart.
It's hard, when you look at an asset, a property, because you are emotionally attached to the past decision, and you so much want that decision to be correct. And with property, it can be really difficult too, because property performs spasmodically. I'm about to publish a report about investment grade apartments and why they have underperformed over the last. It's my observation. I don't know if you agree, Michael, but why they have.
I do.
Yeah, why they've underperformed over the last 8 to 10 years. And so you could have otherwise purchased a fantastic apartment that ticks every single box, but you just haven't seen the performance. So that's why it's difficult with property. Is it a property specific issue? Is it there's something fundamentally wrong with the asset? That's one thing. Or is it a market wide issue? And in fact, your asset is fantastic. And that can be difficult for people to separate those two things. And then, as I said, you've got that emotional decision that, I made this decision. I've spent money on stamp duty. I paid a buyer's agent to find this property. It's cost me, it's given me a few headaches. I've had it now for 7 years. I may as well just hang on to it. But it is a critical decision. You need to, Jim Collins that wrote Good to Great, talked about facing the brutal truth. And sometimes the truth is not really what we want to hear. And sometimes I've had clients that come to me and have a portfolio of 4 or 5 properties, and they're all terrible properties that are never going to work. And so the first thing we need to do is divest of those properties, not overnight, but strategically over a period of time. And it is a very long, expensive, painful, drawn-out process. But we're just not going to be able to move forward with terrible quality assets. So absolutely, you've got to face the brutal truth. You've got to really critically, unemotionally analyze what is the asset and would I buy that asset again today? And that's kind of the asset test. Putting aside, the fact that you have paid, everything's a sunk cost. It shouldn't have any power on our decision-making today.
No, it's a bit like your properties are the employees in your business. And I remember a couple of years ago, I had an employee in my Sydney office who was in a reasonably important position, but really wasn't performing well. And there was some emotions involved because she was a nice person and it was difficult. But I had to take that step, and we had to pay not just a redundancy package, but I had to actually, before I could sack the employee, I actually had to do a performance review. We had to see if we could improve her performance. It's really much the same with properties as well. See how they're performing, see what you can do. Can you change the property manager? Can you do it up? Is it just a function of time? Or is it just a fundamental flaw that's not going to ever be fixed? And so I had to pay a redundancy package, plus I had to pay a recruiter. So I had to go back 2 or 3 steps before I moved forward. Much like with property, where you've got to pay selling fees and maybe even some capital gains tax. But my next manager there has done an amazing job, improved things considerably, brought me a lot more income. And so this is really much the same as the way I look at properties, that yes, you may have to pay a redundancy package to get better employees. I mean, the question I often ask clients if I'm sitting with them talking about this is, what would you do if your employee came late to work and then played on Twitter and Facebook all day and then went for lunch and then came back and didn't see your customers and clients? Well, they'd say, I'd sack them. And I said, well, hang on, this is your employee in your property investment business. It's much the same. So you've got to be dispassionate, don't you?
And there's a saying, you can't build a great business without great people. And then I guess then we can apply that to property. You can't build a great property portfolio without great properties, and it makes sense. So you've either got to make the decision, don't you, to wear it and avoid making the difficult decision and suffer the consequences. And the consequences are you won't probably reach your financial goals. Or the alternative is to make the difficult decision and get some advice around it, be strategic with it, do it prudently, but don't waste time and don't procrastinate.
I think the other important thing is to seek advice, like you said, because we are all a bit too emotionally involved. There's all that sunk emotion in it, and it's hard to make a subjective decision. The other thing is you've got to do numbers and figures. And I know in your firm you have a holistic approach. You don't just look at finance, but you look at the financial planning and the tax side, and you've got the understanding of property. And I believe with Metropole we do the same. And for that reason, we've got calculators, and I know you do also, to see. So if it's going to take 20 years to replace that sunken, lost cost, you wouldn't necessarily sell the property. But if after 3-4 years you can show that having a better property is going to give you better returns, it's going to get you closer to your goals moving forward.
Yeah, sometimes decisions not black and white, is it? And there is some grey. Quite often, if the decision is black and white, if someone's got an apartment they bought off the plan that's in a terrible building, that's just a terrible apartment, it's a really easy decision to make. But if you've got a property that hasn't performed that great, has some good attributes but has some negative attributes, that's the more difficult decision to make. And you've got to then draw that line about, well, if it's an average or it's just even slightly above average property, but I wouldn't buy it again today, but I could have done a lot worse in terms of asset selection. What do you do in that situation? Very difficult, but bang on, you've got to get that advice.
Yes, you do. And you've got to treat your property investments like a business. So every asset has to work hard for you. So your next investment is the most important one. And your first one is even more important because it'll give you the confidence to move forward. Property's a game of finance. We've said that before. You've recently written a new book, The Rules of the Lending Game. It seems even more appropriate now than ever, Stuart. Do you want to tell us a little bit about it?
Yeah, I mean, the rules of the lending game have changed substantially. And as we've spoken about, if you've got access to more investment capital, you can grow your property portfolio at a faster rate. And arguably, you can then afford to invest in higher quality properties. And so finance is critical. And so what I've done is I've written the book to make sure that I arm people with as much information that a mortgage broker would have, that a seasoned property investor would have, so they know how to sort of structure their finances, how to manage their cash flow, and then how to structure loans and grow a property portfolio, and know kind of the rules of the game, if you like. So the banks set the rules, and much like Monopoly, we need to learn and play within those rules, but then we need to exploit the rules for our advantage, just like we do when we're playing Monopoly. So we know to buy houses quickly and put some hotels on them, etc. And so the same is with the game of finance, and that's why I've called it Rules of the Lending Game.
Well, the banks set the rules, but each bank has slightly different rules. And as we said a bit earlier on, the government and ASIC may well change those rules moving forward. So I think it's a really great time to see a proficient finance strategist like yourself and your team, not just to talk about your next loan, but maybe even to assess how your current portfolio of loans is going. Because I'm finding a lot of our clients are refinancing and finding they've suddenly got a lot more cash flow.
Oh, massive. And one of the key things that the RBA and the government, the banks did when COVID hit was to get some really cheap fixed rate money out into the marketplace. And that was one way to help people. And if people decide not to pause their loans, to at least reduce the interest costs in regards to the debt. And so that's been a really good thing that's still in place. And so fixed rates today are just insanely low, particularly for interest-only investment borrowers, because they've been sort of greatly punished to some extent through this sort of credit tightening process with higher interest rates. And so it's very wise to go out and consider that. And it will probably make a material impact to your cash flow, and again, put you in a position to either, buy another investment property, contribute to super, save, put money in an offset account, whatever it might be. But the more cash flow you can control, the more wealth you can build.
Well, we'll put a link to your book, The Rules of the Lending Game, on the Pro Solutions Private Clients website in the show notes, because it's a bit hard to go into bookshops at the moment for some of our listeners, and others are obviously going to be free. But I've actually found the bookshops don't have a wide selection of real estate books at the moment. So easiest to go to your website or Amazon, and I'll leave a link in the show notes. Thank you for our chat. Very interesting. So the bottom line is a couple of game changers with the budget increasing confidence in, hoping to increase confidence in businesses and in consumers. But the big game changers, the change of finance coming in 2021, and that'll underpin our property markets. So a good time to get your ducks in a row to make 2021 a great year in property, Stuart.
Yeah, I think so. And I think it's going to be a wonderful year in property. So I really look forward to it. It certainly can't get any worse than 2020, can it?
Well, in Melbourne, where there's actually been hardly a property market, what did surprise me was way back when we were locked up, that there still were hundreds of transactions every month or every week. Interesting how people manage to still do that. So looking forward to our next chat, Stuart. I'll leave some links in the show notes and look forward to catching up with you again real soon.
Thanks a lot, Michael. It's been great.
I hope you got some insights from my chat with Stuart Wemyss, and in a moment I'm going to share with you my mindset message. And this is probably one of the most important lessons I got from my mentor, Jim Rohn. But before I do, I think it's important to understand that as our property markets are changing and evolving, if you want to secure your financial future, you're going to need more than a property strategist. You're going to need more than the buyer's agent. And that's why my team at Metropole offer a holistic approach to ensure you can grow your wealth, protect your wealth, and pass on your wealth to future generations. At Metropole, we customise a solution to your specific needs. Hey, by the way, we don't sell property, but we've got a time-tested system for acquiring wealth. We help lots of beginning investors buy their first property. We've got a lot of very experienced investors, and we help them add to their portfolio. And for the sophisticated investors who use our services, we help them manufacture capital growth by becoming property developers. But it all starts with putting a strategic plan together and then helping you plan to become the person you plan to become and implement that plan. We hold your hand along the way, but as I said, we don't sell any properties, so no vested interests. Our aim is to help you outperform the markets safely, and using our perspective, using our experience, we'll level the playing field for you. Go to metropole.com.au, find out about what we do, or give us a call at 1300 Metropole. I look forward to being part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'm going to talk about the miracle of personal development. Now, that's a strong word, miracle, but that was the title given to an article by the late Jim Rohn. Now, by now, if you're a regular listener, you'd know that I often quote Jim Rohn in these mindset messages because he was so influential on my personal development. Jim Rohn passed away a number of years ago, but his messages are timeless, and I think this is one of his most important messages. So let's get on with it. Jim Rohn wrote, one day his mentor, Mr. Shove, said, Jim, if you want to become wealthy and happy, learn this lesson well. Learn to work harder on yourself than you do on your job. And Jim Rohn said, since that time I've been working on my own personal development, and I must admit this has been the most challenging assignment of all because this business of personal development lasts a lifetime. You see, what you become is far more important than what you get. And when I heard that lesson from Jim Rohn, it started me on the trail of personal development. So instead of asking about your work, your job, what am I getting? Instead, you should be asking yourself, what am I becoming? Getting and becoming are like Siamese twins. What you become directly influences what you get. Jim Rohn said, think of it this way. Most of what you've done today, you've attracted by becoming the person you are today. Now, I've also found that your income really exceeds your personal development. Sometimes income takes a lucky jump, but unless you learn to handle the responsibilities that come with it, it'll usually shrink back to the amount you can handle. And boy, have I seen that in the very many property investors I've dealt with and the people that I've mentored. In other words, if somebody suddenly hands you $1 million, you better hurry up and become a millionaire. I believe that if you took all the money in the world and divided it equally, you'd soon find that it'd be back in the same pockets, the same proportion as it was before. Jim Rohn explained it, that it's hard to keep that which you've not obtained through personal development. So he suggested the great axiom of life is to have more than you've got to become more than you are. So this is where you should focus most of your attention. Otherwise, you might have to contend with the axiom of not changing, which is, unless you change how you are, you're always going to have what you've got. Well, as we come to the end of another show, I'd like to ask you a little favour. If you got some benefit from today's show, tell somebody else who you think would benefit from the show as well. Just leave us a review on whichever app you're listening to this on, or tell somebody about it. That's even better, of course, because I'd like to make as many people as financially independent, financially fluent as possible, so they know what's going on and they can take advantage of the opportunities our changing property markets are going to offer. I'll be back twice a week with this show, but in between you can keep in contact with me on social media or daily through my property update blog. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?